distinguished guests, fellow panelists, industry leaders, and partners. It's a genuine pleasure to be with you at the Business and Financial Times Money Summit. Let me begin by extending my sincere condemnation to BNFT for consistently providing this vital platform for dialogue and strategic thinking on matters so critical to Ghana's future. That is our financial well-being, our investments, and our savings culture. Year after year, the Money Summit has proven to be a forum and a catalyst for actionable ideas that shape Ghana's financial future. To the organizers, speakers, and all of you here, thank you for your commitment to advancing this dialogue. Fidelity Bank is proud to be once again a partner in this significant event. For us, we don't just participate in these discussions because it's expected of us. We do it because, as Ghana's largest privately owned indigenous bank, we believe we have a unique responsibility to help solve challenges our economy faces. We believe in actively participating in forums like this, where we can contribute our expertise, learn from others, and collectively work towards a more robust and sustainable financial future for all Ghanaians. Why are we here, and why does this really matter to us as a bank? This year's theme, Optimizing Investment and Pensions Management, Strategies for Sustainable Retirement Income and Economic Growth, speaks to something deeply urgent: how we secure the future of Ghanaians through smart and sustainable investments and pension strategies. Because let's face it, retirement security is both personal goal and national imperative. Just like Regina said, she's approaching over 20 years in working, she's looking at retirement. Others here, maybe 5 years. For some of us, maybe 2 or 3 years to retirement. So we are there and it's staring at us right in the face. Are we ready for it? Ghana, like many countries, has witnessed a shift in investment and pension landscape. The recent domestic debt exchange program, do I call it famous or infamous? While a necessary step, has understandably influenced investor confidence and the appetite for long-term investments. But challenges create opportunities. Like I always say, in adversity, there are opportunities. So we need to make the best out of everything. It is more critical than ever that to reignite and desire of our citizens to invest in instruments that will secure their future and drive the nation's economic progress. As a bank deeply rooted in Ghana, we have 3 critical areas where we can collectively turn the tide. And I'll go by it one by one. The first one is sustainable microeconomic growth and fiscal environment. Traditionally, when we think about tackling inflation, especially its transmission through exchange rate volatility, the immediate policy response is often to raise interest rates. While this remains a valuable tool, it's important to explore more nuanced and sustainable approaches, particularly for economies like Ghana. Consider this. Rather than relying solely on interest rate hikes to sustain credit growth, what if we actively encourage small and medium-scale enterprises, that's the SMEs, and larger corporates, to raise medium to long-term financing through the capital market? That's bonds, equity, and other instruments. This will redirect existing domestic capital towards productive economic activities, reducing pressure on the banking system as a primary source of funding. This approach carries strategic advantages, facilitating broader access to capital markets that can promote sustainable economic growth without necessarily stroking the inflationary pressures that often accompany rapid credit expansion. That said, we must recognize a key dynamic factor in Ghana's context. Capital market investors are heavily influenced by short-term treasury yields. When T-bill rates are high, typically in response to tight monetary policy, investors often prefer these risk-free, high-yield instruments over longer-term corporate bonds and equity. As a result, even if capital markets are open to businesses, the availability and pricing of funds may still mirror central bank policy signals. Therefore, while deepening capital markets is essential for long-term financial resilience and efficiency, it must be pursued alongside policies that stabilize macroeconomic fundamentals, especially inflation and fiscal discipline. Only then can capital market financing serve as a true complement to monetary policy, helping maintain more supportive benchmark interest rates without undermining inflation control effects. Like as you see now, interest rates are going downwards. We are about 15, 16%. Policy rates 27, 28. That means that there is that opportunity for us to go onto the other side, whereby we should be able to support the SMEs by raising equity, by raising bonds, by raising some instruments to support them, than relying on government securities, looking at the gap that we have. Because the monetary bet is looking at inflation, pulling it up, but then we need to look at the other side, and how do we support that? The second one is driving pension capital into alternatives through the constituent funds approach. In 2021, the National Pensions Regulatory Authority, that's the NPRA, introduced a forward-thinking regulatory framework allowing for the creation of constituent funds within pension schemes. This is a significant step. It means a pension scheme with multiple constituent funds can adopt distinct investment policies and strategies tailored to the specific age and risk profiles of its members. Be it 5 years of working, 20 years of working, if we can put everyone in his own buckets based on the age and also based on this risk profile, it will be very helpful. Imagine the possibilities. Younger contributors with longer investment horizon could potentially benefit from strategies that include a higher allocation to growth-oriented assets, while those closer to retirement might prioritize more conservative income-generating investments. This is a move away from the one-size-fits-all approach, and it has the potential to unlock significant value for different demographic groups within Tier 2 schemes. However, the reality is that today many investment strategies are still largely guided by the risk appetite of the trustees or the average age of the scheme members. This generalized approach limits our ability to channel pension capital into long-term, less liquid, but potentially high-impact investments. The alternatives such as infrastructure projects, private equity, private debt, and green financing. If we are truly committed to harnessing the full power of pension funds to drive the meaningful economic development, we must actively embrace the tailored approach that the NPRA regulations have made possible. While the framework is in place, we eagerly await the NPR's announcement of a specific implementation date for this constituent funds approach. This will be a crucial step in moving beyond generalized strategies and realizing the full potential of our pension scheme to contribute to sustainable economic growth. The third one is optimizing pension management by attracting top talent. There's a growing tendency to focus on cutting costs without fully considering the long-term implication. This is especially true in the ongoing race to the bottom on pension fund management fees. The discussions around establishing a fee floor for service providers in the private pension fund management space is incredibly important and frankly long overdue. While lower fees might seem appealing in the short term, they pose significant long-term risk that we must address urgently. And I hope today's discussion will also look at that. Think about it. Managing pension funds, the future financial security of our citizens, requires a high level of expertise, experience, and specialized knowledge. If we allow fees to be driven to unsustainable levels, we risk undermining the ability of fund managers to attract and retain the very best term investment. By challenging term investment, and talent. We need professionals who can navigate complex markets, make informed decisions, and ultimately deliver better outcomes for future retirees. Yes, cost matters, but not the expense of quality. A well-structured fee framework that recognizes the value of quality service and professional expertise is not increasing costs. It's about investing in the future security of our pensioners. It's about ensuring that the system incentivizes excellence and professionalism, not just cutting costs. And like as they say, you need to invest in our people for them to be able to come out with the right products, with the right strategies for our pensioners and for ourselves. I'll end by finally talking about the commitment of Fidelity Bank to this. Fidelity Bank's success is not built on short-term gains. We have always prioritized long-term strategies in our support of individual and institutional clients. For nearly 2 decades, our core purpose has been to serve as a trusted partner in developing Ghana's financial future, and we have not looked back. That future must be inclusive. It must be sustainable. It must be grounded in strategies that speak to the lived realities of everyday Ghanaian. That's a farmer, teachers, market women, young professionals, people who simply want to live with dignity today and retire with peace tomorrow, knowing that their future is secured, knowing that their retirement period is secured, and they have no issues. By working together, policymakers, regulators, financial institutions, and individuals, we can reignite the investment appetite, strengthen our pension system, secure the financial future of Ghanaians, and ultimately drive sustainable economic growth for our nation. Thank you very much, and I wish us to have a good session, learning from one another for the good of ourselves and for the good of Ghana as a whole. Thank you.